Thanks everyone for joining us on our June Landowner Insights webinar. We've been having a lot of conversations with folks engaged in the farmland asset class, whether they be current owners or prospective buyers looking at engaging the asset class. And the question is, what's really happening with farmland values, and how do we think about farmland within a portfolio context, given all of the kind of dynamic cost of capital changes, inflation, interest rates, etc. So today, Steve Bruere, president of People's Company, and I are going to have kind of an open conversation about what we're sort of seeing, how we're thinking about things, and just trying to grab some insights that we're learning from the marketplace just a little bit. So we'll start with just a little bit of adding some context and level setting on how farmland works and thinking about what we're seeing. I spend most of my time on the acquisition and the asset management side. And of course, People's Company, we're working across the country, across different kinds of crops and across different geographies and kinds of production systems. And Steve, you're seeing the whole picture, right? You're talking with folks engaged in farmland, looking at all different facets of what to do right now. Tell us a little bit about the sort of dynamic environment.
Yeah, Dave, it is dynamic, and on any given moment, you're having a conversation, as you'd mentioned, with a prospective buyer, somebody who's perhaps considering buying into farmland or making their first farmland investment. Of course, in those conversations, you're really talking about, where we're at in the various cycles and how farmland has performed over time and how it maybe fits into their overall investment thesis. And then at the same time, you may be talking to a seller about, is now a good time to sell my farm? And, you get into a little bit of a slippery slope where on one hand, you're having a bullish conversation, maybe on another hand, you're having a bearish conversation. And you're really trying to give people good advice and help them kind of understand where we're at in the farmland cycle and whatnot. And it gets a little confusing even for somebody that this is all you do all day long, and it's all I've done my entire career is work on farmland transactions. And that question that you get every day of where's the farmland market at, where's it going, what's your crystal ball? Those are great, fun conversations to have. And I look back over my 20-year career, and every time I've pulled out the crystal ball, there's always this unknown factor, whether it's COVID or it's the 2008 financial crisis. There's just always something that pops up, that happens, that changes your outlook. And I think that's what we're going to get into today is, what are the dynamics that impact the farmland markets, and how can those surprise events perhaps change the trajectory? But what do we know and what do we not know, and where's it going?
Yeah, and so we're going to kind of get a little bit into some intense kind of data graphics that lay these factors when we think about the asset class, right? Interest rates, land values, revenue, meaning commodity prices and yield, and how they've all played out over time and what we're looking at now. And we're going to kind of run those through as a backdrop for the conversations. What do we think it means? How have we had some experiences in the past dealing with this confluence of factors? A couple of things to start out with is just making sure we're level set on how farmland functions as an asset class. And this is a 1990 to 2023 aggregated U.S. farmland graphic. So we're looking at cropland values on the line, and we can see pretty incredible growth, particularly since 2003-4 range. But one of the really important takeaways, and we have this conversation with clients that we work with across the different business units quite a bit, farmland really is more about the capital gains over time than necessarily the cash yield. Particularly when we think about stable farmland, we are gaining more wealth, building more value on the appreciation side than we are on the annual cash yield side. And we can see where the cash yield can be a little bit of a trap in some cases. Here's a little bit more of a spatial perspective on that. So we're looking at average annual appreciation over a little over 20 years by state. And then we're looking just at the 2023 cap rates, right? That rough cash yield kind of outcome. And, you know, Steve, you've been focused on this, particularly as you've been directing the land management and asset management platforms over the years on building a platform that focuses on that appreciation as that larger gain versus the cash yield, right?
Yeah, and as you've laid out, there's two return drivers to farmland: the appreciation and then the cash yield. And you know, I've always said that if you're focused on the cash yield, your return that you're getting off of the farmland, and that's your sole driver, then you're oftentimes doing that at the detriment to the long-term appreciation of the asset. So you start to think about, you know, if you're renting your farm out, there's a lot of folks that say, well, I want to get the highest cash rent I can get. And that's usually working against making that asset perform at its highest level in terms of total appreciation. And so when you look at Iowa, for instance, on your maps here, your cap rate, your cash yield that you would expect in Iowa right now, that's about 2.7%, which is probably about right on high quality farm ground. And then your 20-year appreciation rate's 8%. So when you think about buying farmland, if you're focused on the cash yield side of the equation versus that long-term appreciation side of the equation, then you're probably focused on the wrong part of your overall farmland return. And so, you know, you look at Iowa over the last 20 years, you're over 10% total return, cash yield, and appreciation. So we try to build our farm management strategies around how can we make these farms better? How can we improve drainage? How can we improve fertility? How can we create additional, more profitable tillable acres? And how can we align with farm tenants that are going to help us create that superior appreciation for the asset? And there's a lot of folks, when you start talking about farmland, you know, we all like the idea of owning farmland, but then a lot of people look at that return and say, well, gosh, that cash yield's pretty skinny. That doesn't excite me very much. And this is where you've got to take that broader global picture and look at farmland as a total return. And people that are in farmland know that farmland has these underlying appreciation attributes that are significant and they're real. And I think we're going to talk a little bit about, you know, trend line yield and what's happened in farmland over the years. But this approach to managing farmland for long-term appreciation is very critical and an important part of owning farmland.
Yeah, and one thing we certainly know from experience, when you look at the cap rate side and you start to look at some of the states and regions where those cap rates are a little bit higher, you know, you're often dealing with infrastructure, right? Irrigation infrastructure, there's elements of risk and there's depreciation associated with that. And in many cases, just looking at a cap rate, you got to make sure and quantify some of that ongoing investment and sort of cost of keeping the asset performing well over time too. So these are all factors that pop in, and you just have to be really cognizant of how you're thinking about yield versus appreciation. I think is the core message we want to communicate there.
You know what, Dave, one comment on that. You know, I've started to talk about farmland, especially in today's environment, that not all farmland is created equal. And I think a lot of people, and we're doing this to a certain extent today, is we're taking aggregated total returns nationally and at the state level. And that's useful to understand trends and where things are going. But, you know, living in the business daily and understanding how high quality assets and highly desirable neighborhoods perform versus maybe lower quality assets that aren't in as great a neighborhoods. You know, you'll see those high quality assets and high quality neighborhoods outperform on the appreciation side those lower quality assets. So you'll see people once in a while say, hey, cash yield's more important to me, and I'm going to chase cash yield. Well, that's usually going to result probably in a lower total return because your appreciation is not going to be quite as high on those lower quality assets. And so we've seen that play out time and time again. Doesn't matter if you're in Oregon or California or Iowa or Arkansas, being in those high quality neighborhoods with high performing assets with strong community value, that's incredibly important for your total return on farmland.
Yeah, and we're not really going to get into the deep data details on this today, but one of the really interesting sort of data resources that we've started integrating into how we're looking at assets and regions is thinking about the crop insurance data. And when you start digging into the actuarial data master from RMA, you can start to see where you have higher loss ratios, and you get into those scenarios where yes, maybe I can find that higher cash yield, but I'm also seeing a much higher rate of crop insurance claims that adds some risk. Am I going to be able to carry that cash yield through commodity cycles, et cetera? And so this picture is actually getting painted pretty clear in terms of where to focus on resources for predictable outcomes. The next thing we wanted to look at real quick, and this is just a 91 to 2022 chart on total returns. We're lining up the aggregate US Ag 32 states and then several individual states along with some NACREIF data against some public equities. And you can see the farmland returns in total are competitive, right? You can start to add up what you saw on the previous map and get a sense on where we're calibrated here. But one key piece of thinking about farmland, this is another sort of level setting message, is this notion of being negatively correlated with public equities. And so this is thinking about diversification and how you manage your capital into farmland and think about farmland relative to a broader investment portfolio. And essentially what we're saying here is that farmland is going to act in sort of a negative influence versus the public equities. And, Steve, you just actually put out a white paper. You can go to the People's Company website in the industry research link and find this white paper showing a little bit, talking a little bit about this evolution of institutionalization in the asset class. And a lot of this kind of negative correlation with the public equities was a big driver in a lot of institutional folks coming into the asset class.
Yeah, I mean, this is when you hear about investors buying farmland and you see a lot of the headlines around either foreign investment or celebrities or high net worth folks buying farmland. A lot of it was that non-correlation with the rest of the assets they have. And so when you think about people that are buying farmland that aren't farmers, they're generally buying it for that diversification in their portfolio. And we're going to talk a little bit about that today in terms of who's the buyer pool today and how's that capital changing. And that white paper that you mentioned really goes to the essence of the capital that's been coming into farmland over the last 20 years. There's been so much cash chasing farmland returns for that diversification, for that inflation hedge, the thesis around growing demand for food, fuel, and fiber globally and whatnot. And so you've seen a lot of these funds start, 2010, 2011, 2012, and there's been a lot of investment in farmland because interest rates have been so low. Effectively, capital's been free. And so when you look at those farmland returns that we were talking about earlier, appreciation at 8, cash yields at 2 to 3, you've got that 10% total return. Well, from a financial perspective, if you could go borrow money at 3 to 4% over the last 10 years, you don't have to be very creative with math to say, okay, if I can borrow it at 3 and I can get a 10% total return, then your farmland performance has done incredibly well. And what we're going to get into today is, how does farmland perform in a higher interest rate environment where now instead of paying 3 or 4% for your capital, you're paying 7 or 8%, and how's that play out? And that's the big question right now, is how this capital that's been moving into farmland over the last 10 years, what's that going to look like over the next 10 years in a higher interest rate environment where there's alternatives like T-bills and money market accounts and their fixed income that'll give you those types of returns.
Yeah, and the other sort of level setting characteristic of farmland before we get into some of these comparative discussions and kind of thinking about historical performance is the really strong correlation with inflation. So this takes us back to 1970, and we're looking at farmland returns in that sort of aggregate US category as a spread over CPI. And the consistency is pretty astonishing. It's in that range of about 6% on average. There's certainly a couple of periods in here where we see some squeezing, some tightening of that spread. But this characteristic of correlation with inflation is really pretty astounding. And it's largely held over the past few years, but we're going to hop into some things that we're seeing that potentially challenge that characteristic again, like it has in the past, just a little bit.
Yeah, and Dave, on that, I've always said that if you believe inflation, then you should believe in farmland. And this chart really tells the story. And I've always said inflation's good for farmland until it's not. And when it's not is when your Federal Reserve gets serious about controlling inflation, and then they get the Treasury rate above the inflation rate. And we'll get into a few time periods where that's happened and what that means for farmland.
Yeah, so let's sort of kick off this kind of comparative and historical discussion, trying to put it into context right now. There is a lot going on in this chart, and this is sort of a genesis of our almost daily conversations about how do we think about this, and how do we characterize it effectively. I'm going to give you a little bit of background on what we're looking at here as we start to kick into the conversation and what it means. The two core lines that we're tracking across here are that US total farmland values, and we're going back to 1959 here, all the way through 2023. And then we've also overlaid Iowa farmland values, right? And Iowa is a pretty interesting use case because it tends to be pretty responsive to different marketing conditions. The prices tend to run up a little bit faster and react a little bit more harshly to market conditions, and then also correct in the same dynamic. And we kind of see that against this aggregate US total. And we've also got kind of an exponential trend line tracking the Iowa here. And this is interesting because it creates this fit for us to compare in individual periods where we're getting above trend line. And this conversation is really important for the potential buyers, right? How do you think about your timing of buying relative to trend line? Pointing out two other things that are pretty interesting here. So we've tracked just a static line, and this is sort of touching for you personally, Steve, when you were growing up in the farm crisis on a farm in Iowa, 81 to 2003, and then getting into the farmland real estate business 2003 up to 2023. And I'll give you a second to sort of talk about that and some interesting anecdotal stories. But what we've also put across this chart is the 10-year Treasury rate, and this goes back into the late 60s, and then also CPI going back to 1960. And, we kind of talked about how these factors are really tightly tied to what's happened with farmland, and we can start to investigate some of the periods where these trends break. There's chaotic things that happen, and then what's happened with farmland. But Steve, do you want to give a little bit of background on this interesting dynamic of the 81 to 2003 and then 2003 to current, when you've been in the business, kind of set of outcomes?
Yeah, and Dave, to give a little more color on how this came together, because this particular slide came together today as we've been preparing for this presentation, and you and I were having one of our daily conversations around what impacts farmland values. And so, to reiterate what Dave laid out, these are USDA numbers, so there's great data going back to 1959, and so it's pretty fascinating. I was born in 1981, and so the Iowa farmland market peaked in 1981. And so I grew up, my family farms, my folks were Pioneer seed dealers. My grandpa ran the Ford New Holland farm equipment dealership. And so grew up very much in that 1980s farm crisis that a lot of people talk about. And I didn't know any different because I was young, and that's just the environment that you were raised in. But that 81 to 2003 period was kind of a slug. And I remember when I first got into the real estate business in 2003, one of my first real estate deals was a longtime family friend that called and said, "Hey, I want to sell my farm." And it was in 2003. And he said, "My farm is finally worth what I paid for it in 1981. He bought it at the absolute peak in the farmland market, rode that thing down to the bottom in 87, and then rode it on up to the where it passed what it was worth in 2003. So kind of a 20-year slog there, where the market corrected and it had to climb out. And so, Dave, you'd mentioned, this is particularly useful for people that are buyers, but it's also particularly useful for people that are sellers too. And this gets into that dynamic that we talked about at the beginning of the call when somebody asked me, what do you think the farmland market's doing? Where do you think it's going? I've been wrong so many times on the crystal ball. So all you can really talk about is what are the fundamentals that drive farmland values. And I think what we've laid out here, we showed the CPI, that's inflation. So we showed how farmland's correlated with inflation over time on a previous slide. And then we talk about interest rates and commodity prices. And so you've got and we'll get into the commodity prices on another slide, but you've got your 10-year treasury yield here. And so a lot of folks will talk about how people's companies performed over the last 20 years in inside conversations as we've grown the business. And I've always said, well, interest rates have gone down every year of my career since 2003, effectively. And so there's been a lot of great tailwinds as I've been in the farmland business, because the cost of capital got cheaper every year. And so as capital got cheaper, it made your ability to service debt on farmland that much easier. And so you go back to our example that I talked about earlier of Iowa, 2.7 cash yield, 8% appreciation, total return of 10. When you can borrow money at 3 to 4%, it's pretty easy to be successful at investing in farmland over that last 20-year period. And so the big question here, as you look at this slide, is we now have a higher cost of capital for borrowing, and farmland values are a little bit above trend line right now, as Dave's showing here. And so if you're a seller, is now a good time to sell. And if you're a buyer, is now a good time to buy. And what none of us know is what would be the next event that could make commodity prices rally, or what's the next event that could cause interest rates to go down. But if the world was to just stay static for a second and interest rates aren't going to change and commodity prices aren't going to change, then farmland's probably a little overpriced right now relative to the trend line. And so, Dave, you might have some other thoughts you want to add to that. But there's a lot going on here. But when you really get right down to it, what drives farmland values? It's commodity prices, it's interest rates, and then it's supply and demand. And we'll talk a little bit about the amount of debt that there is against farmland and how much land hits the public market on an annual basis here in a little bit.
Yeah, so if you go back historically and you start thinking about CPI outrunning the treasury yield, right? There's only a handful of periods where we see that happen. And certainly they can be associated with some disruptions, right? Some fairly dynamic periods in farmland values when we track that across. Usually there's a little bit of a lag in how that plays out. We're in one of those periods now, right? So there's about 3 significant overruns from CPI to the treasury yield going back into the mid to late 70s. And then most recently, there's been a couple of other minor inversions more recently, but they've been fairly tight. And one of the things that we're definitely seeing in the marketplace is folks are starting to step back and think about competition for their capital just relative to fixed income, right? So when and Steve highlighted the total returns on farmland, the stability, et cetera, being really appealing for quite a long window here where cost of capital continue to get cheaper. Now, all of a sudden, where do these lines, when we think about CPI and the treasury yield, where do they move from here? And how does that impact the appeal of farmland, particularly with folks that do have that cash yield, that current income driver and what their capital source is wanting? That has the potential to be pretty impactful, and we don't quite know, right? What are the disruptions? How does inflation and the Fed's policy start to interact and having these lines come back together? Where do they go from here? That is impactful, and we can see that historically when we overlay these data sets.
Yeah, Dave. So one thing, just to jump in here. So what jumps out at you is like 1971 to that 73 period where CPI is actually above the 10-year Treasury yield, and that was the great grain robbery, I believe, in 1971, where the price of corn went from $1 to $3. So you had an interest rate environment that was rising, but you also had a commodity price environment that created a lot of net farm income for folks. You jump into like 1981, that's when Paul Volcker came in and took the 10-year Treasury rate above or the federal funds rate above the cost of inflation. And so some of these time periods jump out, and another one that's jumping out to you right now is where we're at right now. And that's what nobody knows. And so we end up on phone calls with folks. I was on one yesterday where there's a strong belief that we're at the beginning stage because of the fiscal policy in this country, where inflation is going to last quite a while and it's going to get much more severe. And so if you believe that, and that's the camp that you're in, then you probably want to own farmland versus being in a fixed income like a T-bill, where all you have is cash yield. You have no appreciation potential. You know, farmland, you have both, and that's why people like farmland, and why there's folks right now that are saying, hey, where else would I put my money? Where else would I invest in right now other than farmland if they believe, the stock market's too high and they're worried about inflation and they don't want to be inflated away on fixed income. So these are all the dynamics that are, going through people's heads right now.
Yeah, I think the absolute clearest takeaway when I look at this data, Steve, is that you literally could not have picked a better year to get started in the farmland real estate business than the one you did.
I always joke around that I offer a money back guarantee on the farms that I've sold, and that nobody's ever wanted their money back. And so, but that's a function of the cost of capital getting cheaper, and we'll see what the next 20-year cycle looks like.
You bet. So let's flip this and think about a little bit more of that. That was a lot of sort of unknowns, right? So, hey, characterize what's happened in the past, how we know farmland functions relative to inflation, relative to the competitive yields in fixed income space, et cetera. Let's move it a little bit more to the optimistic side, understanding how farmland and why farmland continues to appreciate at the level it does. And what we've done here is take Iowa corn yield, again, using USDA data going back to 1959, and overlay this productivity. And this is actually a really important part of the story, right? We continue to produce more with less. We've seen the lines converge, right? And this is always relative to how you structure the graph. But in this particular structuring, we see a little bit of convergence on values against the yield. One of the things that jumps out when we look at this, going back, say, pre-mid 90s range, is the intense volatility in that yield. And volatility gets priced into the marketplace when we're thinking about land values and obviously the revenue to the land, the cash rents. Volatility gets priced in with that risk premium when you have these kinds of ebbs and flows in that productivity. So not only are we moving into a space where we're considerably more productive on a per acre basis, but we're also much more predictable. And, 2012 was a very large drought across the entire Midwest, but it was actually incredibly profitable for farmers because they had crop insurance, right? And they'd been coming off of really high productivity years, so their proven yields were high. Prices ran substantially, and 2012 was one of the very premier net income years. And so when we look at this sort of volatility of yield component, thinking about how crop insurance has emerged across the late 90s and certainly over the last 25 years as a revenue hedge, guarantee with that minimum annual revenue guarantee, that's actually pretty substantially impactful as well.
Yeah, and Dave, you've got some great data resources on the RMA actuarial data on trendline yield going back 50 years. Are you able to jump into that data?
Yeah, I can pull up what we call our insights tool. Are you seeing that, Steve?
Yep.
Yeah, so this is really pretty fundamental to how we're looking at any asset, and then thinking about regions is starting with this crop insurance data, because we're getting RMA is building all of this actuarial data off of really strong reporting. We're talking about 93% plus of all acres in the U.S. are using federal crop insurance products, and that requires reporting productivity and understanding all of those outcomes. And we start to get into some really interesting outcomes that we can quickly assess regions, locations, etc. This is our Farmland Insights tool. We're continuing to refine a couple things, and this is available on the People's website. And then certainly the underpinning data is a big part of how we work with assets. So we can start at a state level, and you can see the farmland values, right? Similar trends. You can add states and start to compare. We can also look at that cash rent, that income history, and similarly return history at the state level, right? And so you can move up and down, just understanding exactly what our total return has been. And where it starts to get really interesting when we're actually working in the business is when we step into individual locations. And a lot of this data is going to come out at say, a county scale. I have some personal farming assets here in Butler County, Iowa. And so we can start to get a really good characterization of, hey, what's the price down at that county level? What's rents at that level? How do we think about soil productivity, expected yields going forward? And then start to look at what's that yield trend history. And this yield trend, when you start to put that on maps and comparing what's happening across different areas and regions, becomes pretty powerful, just in terms of getting a really quick characterization of how things are going. How are we driving additional value from a productivity standpoint? And other elements that are coming in are the loss ratios that we mentioned earlier, right? What's the actual actuarial risk that's accumulated over time based on losses that have actually been paid out? And this is where that RMA data gets really powerful.
So Dave, on Butler County, what is that 72 to 22? What's that trendline yield number?
Yeah, it's we're adding about 2.34 bushel a year.
So, to give that context, there's a lot of people that look at farmland and say, where's the appreciation come from? Like, why are you so confident that farmland is going to continue to appreciate and do well over time? And this trendline yield curve is just really valuable data, and you can really start to see how farmland performs based on the trendline yields. And so we've started aggregating this at the county level for every state in the U.S. And so when we're looking at farmland assets, I've talked about not all farmland's created equal, but you'll see in those lower quality areas, you're not seeing that same advancement in trendline yield that maybe you see in your higher quality central Illinois, northern Iowa type of counties. And so getting assets, this plays into that concept of managing for appreciation. So if you buy a farm today in Butler County, Iowa, 10 years from now, you're going to be looking if that trend line holds, which we believe it will, 20 to 30 bushels more corn per acre on that same farm. And so when you go to sell that farm, you're now maximizing the productive capacity of that farm and the net income of that farm based on these trend lines.
Yeah, so that kind of gets into the optimistic component of where we think farmland's going, and there's several other pieces that will sort of highlight that fit into that same set of outcomes. We also wanted to take the same farmland value perspective and line it up against the crop prices. And Steve highlighted that run up in 1971 and how that fit into one of the earlier charts. This is really pretty interesting when you start to look at what's happening, what's happened with corn prices, and how the farmland value elements tied pretty close just with the requisite delays. And this fluctuation is pretty substantial. And you think about where we're at today. I think I got a text earlier that we're down maybe as much as 10 cents on the board, approaching that sort of $4 mark. I don't know if that floor is there, but we think about that relative to that 1971 run that took it up over $3 and how that plays out. So this is another one of those unknowns where perhaps there's some pessimism that starts to jump out, or at least caution relative to what's happening in the commodity markets.
Yeah, and Dave, to tackle that, kind of wearing both a buyer and a seller perspective. So, if you're considering buying farmland right now, you'd probably look at a lot of this data and feel like you're at the higher end of the curve right now, and in fact, you're probably a little bit above trend line on farmland values. And some of this data we don't have aggregated today, but when you look at farmland, there's about $4 trillion worth of farmland in the U.S., and it's leveraged at about 13%. And so when folks say, hey, what do you think the farmland market's going to do? If you look at commodity prices and you look at interest rates, you'd probably arrive at the conclusion that farmland prices are going to soften as a result of higher interest rates and lower commodity prices. But then if you jump over to the inflation side of the equation and say, okay, farmland and inflation are correlated, and if we're going to continue to have strong inflation, and you have limited supply of land available, 1 to 2% of all farmland hits the public market on an annual basis, and as I said, it's only 13% leveraged, and so supply and demand of farmland plays into this equation as well. And if people don't like the price of farmland, these are generational assets. So if they don't like their price, they just don't sell it. And so these are the conversations I'm having every day right now with sellers. Hey, is now a good time to sell my farmland? And it's like, well, there's a limited amount of supply. Commodity prices are softer, interest rates are higher, but yet the farmland market's been incredibly resilient. And it's because there's still more capital out there that wants to own farmland than there is supply available, and that's a huge factor. And so when I talk to folks that say, hey, I want to buy farmland, but I want the market to cool off a little bit, I don't know if the market does cool off to the degree that maybe you think that it should, because there's just not going to be supply. And Dave and I have spent quite a bit of time with some larger landowner clients recently that we've talked about what drives farmland coming to the market, and high prices do bring farmland to the market that otherwise maybe wouldn't have came to the market. And these are generational assets, and so when you've got record high prices, people like to sell farmland into those types of markets. And when prices are not perceived to be as high, then they just decide to keep it, because where else would you put your money that you like better? And so all this stuff plays into, if you're a seller, is now a good time to sell? Well, we're certainly at one of the highest points in the history of farmland for values, even if it has softened just a little bit. And if you're a buyer, I think it's more around the inflation hedge and the correlation or non-correlation with public equities, and do you want that diversification? And so when you're putting on your buyer hat, I think the market's going to actually give buyers an opportunity to buy farms right now where they're not competing against as many people to buy assets. And so you start getting into this. I can be convinced to sell and I can be convinced to buy. And this is where the crystal ball conversations always break down for me, because long term, you're a fundamental believer in farmland. And I've never felt stronger about the farmland markets and all the things that are happening around wind and solar and carbon and these trend line yield increases that we've demonstrated. But yeah, you've got some headwinds with commodity prices and interest rates.
Yeah, and so the natural question, Steve, again with the buyer hat on, if you bought some farmland right now and then the marketplace corrected 20% over the next 2 years, what would you do?
Yeah, you'd buy more.
That's right.
And I think I think that's where if you look back at some of these charts that we put together, there's a few time periods, and I think folks that look back at that 1980s farm crisis, looking back, it's easy to say this, but if you could have bought all the farmland that you could buy in the 1980s, you'd be really pleased today. And I don't think we're going to get a 1980s environment, because you have this underlying crop insurance system. Farmland's not as leveraged to the degree. We looked that data up this morning, Dave. I think 1985 leverage was 22% for farmland, and today it's 13%, which
right.
is still, yeah. So you have very little leverage against the asset class and very little inventory. And so I just don't see a major correction coming for farmland. But at the same time, if you're a seller and you're thinking about selling, I don't think you're necessarily going to see a window to set a record high price here in the next year or two either. I think it's going to be pretty stable.
Yeah, so kind of wrapping up this outlook, and obviously we've talked around all sides of this and kind of laid out several of the factors that are key drivers. The reasons for optimism are pretty clear, right? And it first and foremost comes down to this scarcity issue. And then how does that actually reflect in terms of how land's getting used now and going forward? Right. We see the continuously increasing productivity, particularly on higher quality land, and that just creates more revenue. And then we've really organized the business to make sure that this emerging set of kind of new revenue sources, whether that be renewable energy, whether that be, in the battery storage arena and other sort of the carbon capture arena, these are substantial sources of revenue going forward. The business models are not completely clean, not completely flushed out. But we've really focused on trying to build the business around being able to identify and bring those sources of revenue in. And they're going to expand even further when we start thinking about business models around ecosystem services. So these are reasons for optimism around why land can carry. Any sort of additional thoughts there, Steve?
Yeah, I think you nailed it. I think there's a little bit of a renaissance going on the renewable side right now, where with artificial intelligence and the demand for electricity and the Inflation Reduction Act and all the money that's been targeted at renewable energy, that all takes land. And I don't think that's been capitalized into farmland. And so I think, over the next several years, these business models, you and I have talked about renewable aviation fuel, and we've talked about biodiesel, and we've talked about the impacts of carbon on farmland values. I don't think that's priced into farmland today, and so you can't not pay attention to how those things will price in, and I think anybody who's got a piece of farmland with a 345 kV line running through it right now is probably getting approached by wind developers, solar developers, data centers that are looking for the ability to tie up that land and use it, because it takes farmland in order to solve a lot of these renewable energy issues. And then on the trend line yield, I just can't say enough about that. Dave, whether it's corn or soybeans or whatever, we've got this data aggregated from RMA, but sometimes folks will say, hey, how long can that trend line yield go? And I've heard you talk about the genetic makeup of a corn plant. And can you hit that real quick? Like, where could yields actually go over time?
Yeah, so in a perfectly managed environment, the theoretical maximum corn yield is actually over 600 bushel an acre. Now, obviously, in a non-greenhouse, in an outside environment, we're never going to hit that perfect environment, but there is a lot of room to continue to maximize yield. And as we start to move into new arenas of soil health management, new arenas of water management. One of the fun ones for us is we've gotten to work in other regions. If you don't get 200 bushel corn in Iowa, something went wrong. Well, if you go out to Washington State in the Columbia Basin and you don't get 300 bushel corn, something went wrong. And certainly, we have operators we work with in Central Illinois where 300 is very like a whole farm average, 300 bushel yield. That's just right around the corner. So there's not a significant slowdown in the near term on that yield gain.
Yeah, so when you package all that together, the global demand for food, fuel, and fiber, the trendline yield increases that we can document actuarially, the renaissance in the renewable space. I've never been more bullish on farmland, and I tell folks that any piece of farmland, and you can study history all the way back to the beginning of time in the U.S. But if you've got a long-term time horizon, long-term being longer than 5 years, there's just never been a period where you buy a piece of farmland that it's not going to be worth more at the end of 10 years than the day you bought it. And you've got that cash yield, no vacancy, underwritten by crop insurance, and you've got all the optionality of all the things that can happen with wind and solar and carbon on top of that. And that's why I'm really, really bullish about long-term trajectory for farmland values. And in markets like this where there's some uncertainty around where it's going, it's also, if you're a long-term holder and buyer of farmland, it's going to give you some opportunities to buy some assets where maybe not everybody's got that long-term commitment, and they've been chasing it for the wrong reasons over the last 10 years.
Yeah, and Steve, you brought it up when you started thinking about renewable diesel and sustainable aviation fuel, SAF. One quick note on that long-term kind of bullish perspective, those market scales are actually 4 or 5 times bigger than current ethanol production. It's really, really substantial, and there's a great story there. The pessimistic side in the near term really comes back to cost of capital and some levels of uncertainty driving a little bit of kind of a locked up, halted market to a certain degree, wouldn't you say?
Yeah, and again, farmland's a generational asset, and the time to buy is when somebody wants to sell, and so commodity prices and interest rates are more short-term and influences, and all these other things we're talking about are more long-term. And so while the current commodity price environment and the current interest rate environment makes farmland a little more challenging, I think that is what is the buying opportunity for folks. But also, if you're considering selling, and you're thinking, okay, next year the farmland market's going to be more vibrant than it is today, or I'm going to wait 2 or 3 years. I think it's going to take a little while for this interest rate and inflation environment to sort itself out. And as I said earlier, if interest rates stay exactly where they're at, and commodity prices stay exactly where we're at, then in the short term, farmland's probably a little overpriced. But I think a lot of people want to see the whole farmland market move in order to make a move. And what I can tell folks, like I watch it every day, and there are farms, if you're out paying attention and you're out hustling, you are working, that you can buy that you feel really good about today. And when you were talking about the corn yield being 300 bushel in Illinois in the future, like that's what gets you excited about buying high quality farms, is knowing that if you don't have to compete with as many people today to get those farms bought, and you are a long-term believer in the drivers of farmland, then now is a great buying opportunity for folks that want to get into the space. And so you do find yourself talking out of both sides of your mouth on this optimism and pessimism thing. But for me, it's more about, what you're trying to accomplish personally. And I've always said, if you had unlimited financial resources and there's no family dynamics driving transactions, nobody would ever sell any farmland. You just own it forever, and that's why it's a generational asset, and it's so hard to get your hands on. And at the end of the day, my optimism definitely trumps my short-term pessimism around interest rates and commodity prices.
Yeah, and the unknowns really are the timelines and the trajectories on inflation, interest rates, and commodity prices. We don't know, global conflict, right? Large scale impacts. Just think of COVID as an example. These kinds of resets and how they impact that confluence of factors is what's really hard to nail down. If you had that crystal ball and you could knew over 5 years what was going to happen to inflation, treasury yields, interest rates, and commodity prices, then it wouldn't be too difficult. But that's where the uncertainty actually comes in.
Yeah, and you have the geopolitical issues around wars in Ukraine and Russia and what's happening in the Middle East, and now you've got the bird flu potentially, getting into some of the dairy industry, and those are the unknowns. But that's actually where you appreciate the stability of farmland, because those unknowns, when you're in public equities or other assets, are what can destroy wealth really quickly. And if you can be in a stable asset like farmland, a lot of people find that to be a safe haven asset that, when all else fails, that's where you want to be. And that's what we're seeing is, even though there's some of these dynamics, headwinds for farmland, there's a lot of capital out there that's looking for a safe place to be right now. And farmland's where they're choosing to be from a safe and secure and inflation hedge point of view. So a lot of factors that go into it. And this conversation, we have it every day. I have it every day with anybody who will talk to me about it. And I'm learning every day from every conversation I have, and you try not to make any predictions, because those unknowns are the drivers that really come out and make your crystal ball wrong.
Yeah, with that, I think that probably saves us for the typical, hour-long evening conversation about what's happening for today, Steve, but we should probably let everybody go. Appreciate the time and listening to this sort of conversational approach to thinking through all of these factors. And please feel free to email me with any questions, and we look forward to seeing you again on the future Landowner Insights webinars. So thank you very much.